Question 1. Process analysis reveals that the current underwriting workflow for commercial property insurance applications is being optimized for speed and efficiency. During this analysis, a set of common early warning signals, such as inconsistencies in reported building materials, unusually low reported occupancy rates for the stated business type, and a history of multiple prior claims with different insurers for similar risks, been identified as potentially indicative of misrepresentation or adverse selection. Which of the following approaches best balances the drive for process optimization with the regulatory imperative to address these early warning signals? Option A. Disregard the identified early warning signals during the optimization process, focusing exclusively on reducing application processing times to meet internal efficiency targets. Option B. Rely solely on automated flags generated by the underwriting software to identify potential issues, without any subsequent human oversight or contextual analysis of the flagged signals. Option C. Mandate a comprehensive manual review of every application that exhibits even a single minor early warning signal, regardless of its potential impact or the overall risk profile of the applicant. Option D. Implement a tiered review system where identified early warning signals trigger a more detailed manual review by a senior underwriter, with the threshold for escalation based on the number and severity of signals detected, ensuring that high-risk applications are flagged without delaying the majority of straightforward cases. The correct answer is D. Implement a tiered review system where identified early warning signals trigger a more detailed manual review by a senior underwriter, with the threshold for escalation based on the number and severity of signals detected, ensuring that high-risk applications are flagged without delaying the majority of straightforward cases. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need for efficient process optimization with the critical regulatory obligation to identify and act upon early warning signals of potential fraud or adverse selection. The pressure to streamline operations can inadvertently lead to overlooking subtle indicators that, if addressed proactively, could prevent significant financial losses and uphold the integrity of the underwriting process. Careful judgment is required to ensure that efficiency gains do not compromise the thoroughness of risk assessment and compliance. The correct approach involves integrating a review of early warning signals into the optimized underwriting workflow, ensuring that these signals trigger a more in-depth review without unduly delaying the overall process. This aligns with regulatory expectations that insurers maintain robust systems for detecting and managing risks, including those associated with fraudulent applications or deteriorating risk profiles. Specifically, regulatory frameworks often mandate that insurers have procedures in place to identify suspicious patterns and take appropriate action, such as further investigation or referral to a fraud unit. This proactive stance is ethically sound as it protects the insurer, its policyholders, and the broader insurance market from the negative consequences of fraud and adverse selection. An incorrect approach that focuses solely on speed and volume, disregarding the identified early warning signals, fails to meet regulatory requirements for risk management and fraud prevention. This oversight can lead to the acceptance of substandard risks or fraudulent policies, resulting in financial losses and potential reputational damage. Ethically, it represents a dereliction of duty to safeguard the insurer's assets and maintain fair pricing for all policyholders. Another incorrect approach, which involves escalating every identified early warning signal for manual review regardless of its severity or context, leads to process inefficiency and can overwhelm investigative resources. It demonstrates a commitment to investigating signals. It lacks the nuanced judgment required for effective risk management and can create bottlenecks, undermining the very optimization efforts being pursued. This approach may not be explicitly prohibited by regulation, but is professionally suboptimal and can lead to wasted resources. A third incorrect approach, which involves relying solely on automated flags without human oversight or contextual understanding, risks misinterpreting data and generating false positives or negatives. While automation is a key component of process optimization, regulatory expectations often imply a need for human judgment in interpreting complex risk indicators. Over-reliance on purely automated systems without a mechanism for human review can lead to regulatory noncompliance if critical signals are missed due to system limitations or data anomalies. The professional decision-making process for similar situations should involve a risk-based approach. Underwriters should first understand the regulatory requirements for identifying and managing early warning signals. Then, they should evaluate the effectiveness of existing processes in detecting these signals. When optimizing processes, the focus should be on embedding mechanisms that allow for the timely and appropriate investigation of these signals, rather than their complete omission. This involves developing clear criteria for escalation, leveraging technology for initial screening, and ensuring that human expertise is applied where it adds the most value. The goal is to achieve a balance between efficiency and robust risk management, ensuring that process improvements do not inadvertently create vulnerabilities. Question 2. Comparative studies suggest that while historical financial performance is a key indicator, underwriters often overlook critical qualitative factors that can significantly impact a commercial entity's risk profile. Considering the regulatory framework for commercial underwriting in the United States, which of the following analytical approaches would be most effective in identifying potential future financial distress and ensuring accurate risk assessment? Option A. A comparative analysis against industry average financial ratios without investigating the specific reasons for any deviations. Option B. An exclusive reliance on liquidity ratios, including the current ratio and quick ratio, to assess the company's short-term solvency. Option C. A comprehensive review of the company's footnotes to the financial statements and the management discussion and analysis (MD&A) section to identify disclosures regarding contingent liabilities, significant litigation, and changes in accounting policies. Option D. A primary focus on historical profitability ratios, such as net profit margin and return on equity, to gauge past performance trends. The correct answer is C. A comprehensive review of the company's footnotes to the financial statements and the management discussion and analysis (MD&A) section to identify disclosures regarding contingent liabilities, significant litigation, and changes in accounting policies. Explanation. This scenario is professionally challenging because it requires the underwriter to move beyond a superficial review of financial statements and delve into the qualitative aspects of a company's financial health, particularly in the context of potential future risks. The underwriter must exercise sound judgment to identify red flags that might not be immediately apparent through simple ratio analysis. The OM designation implies a need for a sophisticated understanding of risk assessment beyond basic underwriting principles. The correct approach involves scrutinizing the footnotes and management discussion and analysis (MD&A) for disclosures regarding contingent liabilities, significant litigation, or changes in accounting policies that could materially impact the company's financial position or future performance. This approach is correct because regulatory frameworks, such as those overseen by the Securities and Exchange Commission (SEC) in the U.S., mandate comprehensive disclosure of material information that could influence an investor's or underwriter's decision. Specifically, generally accepted accounting principles (GAAP) and SEC regulations require detailed explanations of significant risks, uncertainties, and commitments. Ethical underwriting practices, as guided by professional bodies and industry standards, demand a thorough due diligence process that uncovers all relevant information, even if it requires more in-depth analysis than standard financial statement ratios. Incorrect approach that focuses solely on historical profitability ratios, such as net profit margin or return on equity, fails to account for future uncertainties. This is a regulatory failure because it neglects the requirement to assess forward-looking risks and potential impairments to future earnings, which are critical for underwriting commercial risks. Ethically, it represents a failure of due diligence, potentially exposing the insurer to unforeseen losses. Another incorrect approach that relies exclusively on liquidity ratios, like the current ratio or quick ratio, overlooks the qualitative factors affecting a company's ability to meet its obligations. Liquidity is important. It does not capture the full spectrum of financial risk. This is a regulatory and ethical failure, as it fails to consider the broader financial stability and operational risks that could impact a company's long-term viability, which are essential for accurate risk assessment in commercial underwriting. A third incorrect approach that prioritizes industry average comparisons without investigating the underlying reasons for deviations is also flawed. While benchmarking is useful, it is insufficient on its own. This approach fails to meet regulatory expectations for a detailed understanding of the specific risks of the applicant. Ethically, it suggests a lack of independent critical analysis and a reliance on superficial comparisons, which can lead to mispricing of risk and inadequate coverage terms. The professional decision-making process for similar situations should involve a multifaceted approach to financial statement analysis. This includes 1. A thorough review of the primary financial statements, balance sheet, income statement, cash flow statement. 2. Deep dives into the footnotes and MD and for qualitative insights into risks, strategies, and accounting treatments. 3. Consideration of industry trends and competitive landscape. 4. Assessment of management quality and corporate governance. 5. Identification of potential red flags in areas requiring further investigation or clarification from the applicant. This comprehensive process ensures compliance with regulatory disclosure requirements and upholds ethical underwriting standards by providing a robust and informed risk assessment. Question 3. Benchmark analysis indicates that the applicant's income statement shows a consistent increase in gross profit margin over the past 3 years, yet their net income has remained relatively flat. Which approach to analyzing this income statement is most appropriate for an associate in commercial underwriting management to assess the applicant's financial health and risk profile? Option A. Prioritize the absolute net income figure as the primary determinant of financial stability, regardless of other trends. Option B. Assume that the flat net income is a temporary anomaly and proceed with underwriting based on the positive gross profit trend. Option C. Investigate the specific operating expenses and other income/expense lines to understand why net income is not growing in proportion to gross profit. Option D. Focus solely on the positive trend of gross profit margin as an indicator of strong operational efficiency. Correct answer is C. Investigate the specific operating expenses and other income/expense lines to understand why net income is not growing in proportion to gross profit. Explanation. This scenario is professionally challenging because it requires an underwriter to move beyond simple numerical review of an income statement and instead interpret the underlying business performance and its implications for risk. The pressure to make a quick decision based on readily available data can lead to overlooking critical qualitative factors. Careful judgment is required to balance the need for efficiency with the fiduciary duty to accurately assess risk for the insurer. The correct approach involves a comparative analysis of the applicant's income statement against industry benchmarks and historical performance. This method is correct because it provides context and highlights deviations that warrant further investigation. By comparing against industry averages, the underwriter can identify if the applicant's performance is an outlier, suggesting either superior management or potential underlying issues not immediately apparent. Comparing against historical performance reveals trends, such as improving or deteriorating profitability, which are crucial for predicting future performance and solvency. This approach aligns with the regulatory expectation that underwriters conduct a thorough and prudent assessment of risk, ensuring that underwriting decisions are based on a comprehensive understanding of the applicant's financial health and operational efficiency, thereby upholding the principles of sound insurance practice and solvency. An incorrect approach would be to solely focus on the absolute profitability figures without comparison. This fails to identify whether the reported profit is merely in line with industry norms, or if it represents a significant improvement or decline relative to peers or the applicant's own past performance. This superficial review risks misinterpreting average performance as exceptional or overlooking a concerning downward trend. Another incorrect approach would be to prioritize revenue growth above all else, even if it comes at the expense of declining profit margins. While revenue growth is important, sustained profitability is a more critical indicator of long-term business viability and the ability to service debt or meet financial obligations. Ignoring the impact of revenue growth on profitability can lead to an underestimation of financial strain. A third incorrect approach would be to assume that a positive net income automatically signifies a healthy business without scrutinizing the components of that income. For instance, significant one-time gains or aggressive accounting practices could inflate net income, masking underlying operational weaknesses. This approach neglects the detailed analysis required to understand the sustainability and quality of the reported earnings. Professionals should adopt a decision-making framework that begins with understanding the purpose of the income statement analysis within the underwriting context. This involves setting clear objectives for the analysis, such as assessing the applicant's ability to pay premiums, their financial stability, and their likelihood of default. The framework should then guide the underwriter to gather relevant data, including the applicant's income statement, industry benchmarks, and historical financial statements. The analysis should proceed with a comparative approach, looking for trends and deviations. Any identified anomalies should trigger further investigation, potentially involving requests for additional documentation or clarification from the applicant. This systematic process ensures that underwriting decisions are informed, objective, and compliant with regulatory standards for risk assessment. Question 4. Investigation of the most appropriate method for assessing the creditworthiness of a commercial insurance applicant, considering the need to balance profitability with regulatory compliance and prudent risk management. Option A. Conduct a thorough review of the applicant's financial statements, credit reports, and relevant industry risk factors to form an independent assessment of their ability to meet obligations. Option B. Prove the application based on the applicant's long-standing relationship with the insurance broker, assuming the broker has already vetted the client's creditworthiness. Option C. Rely exclusively on the credit rating provided by a reputable external credit rating agency without conducting independent verification. Option D. Accept the applicant's projected financial performance as presented, assuming future success based on their stated business plans. The correct answer is A. Conduct a thorough review of the applicant's financial statements, credit reports, and relevant industry risk factors to form an independent assessment of their ability to meet obligations. Explanation. This scenario presents a professional challenge because the underwriter must balance the need to secure profitable business with the imperative to adhere to stringent credit risk assessment principles and regulatory requirements. The pressure to meet targets can create a temptation to overlook or downplay potential credit weaknesses, which could lead to significant financial losses for the insurer and potential regulatory sanctions. Careful judgment is required to ensure that underwriting decisions are based on a thorough and objective evaluation of the applicant's creditworthiness, rather than on short-term business objectives. The correct approach involves a comprehensive review of the applicant's financial statements, credit reports, and industry-specific risk factors, followed by a reasoned assessment of their ability to meet their contractual obligations. This approach aligns with the principles of prudent underwriting and the regulatory expectation that insurers manage their risks effectively. Specifically, under the Associate in Commercial Underwriting Management (OM) framework, which emphasizes sound risk management practices, this thorough due diligence is paramount. It ensures that the insurer is not exposed to undue credit risk, thereby protecting policyholder interests and maintaining the financial stability of the company, as mandated by regulatory bodies overseeing commercial insurance operations. An incorrect approach would be to rely solely on the applicant's stated financial projections without independent verification. This fails to meet the regulatory requirement for due diligence and exposes the insurer to significant risk if those projections are overly optimistic or unrealistic. It bypasses the critical step of assessing historical performance and the underlying assumptions driving future expectations, which is a cornerstone of sound credit risk analysis. Another incorrect approach is to accept the applicant's credit rating from a third-party agency without further investigation. While credit ratings can be a useful indicator, they are not a substitute for an underwriter's own assessment. Regulatory guidelines often require insurers to perform their own risk assessments, and over-reliance on external ratings can lead to overlooking specific nuances of the applicant's financial health or industry-specific challenges that the rating may not fully capture. Finally, an incorrect approach would be to approve the application based on a strong existing relationship with the applicant's broker or agent, without a robust credit risk assessment. This prioritizes business relationships over sound underwriting principle and can lead to accepting substandard risks. It violates the ethical obligation to act in the best interest of the insurer and its stakeholders by potentially exposing the company to unacceptable credit losses. Professionals should employ a decision-making framework that prioritizes a systematic and objective evaluation of credit risk. This involves gathering all relevant information, analyzing it critically, and making a decision based on the findings, irrespective of external pressures. The framework should include clear guidelines for risk assessment, documentation requirements, and escalation procedures for complex or borderline cases, ensuring compliance with all applicable regulations and ethical standards. Question 5. The evaluation methodology shows that a proposed process optimization within the commercial underwriting department could significantly reduce operational costs and improve turnaround times. However, the optimization involves a shift in decision-making authority for certain risk assessments, potentially impacting the established lines of reporting and oversight to the board. Which approach best aligns with robust corporate governance principles and regulatory expectations for this scenario? Option A. Present the proposed process optimization to the board's Risk and Audit Committee for review and approval before implementation. Option B. Delegate the decision to approve the process optimization to a newly formed cross-departmental efficiency task force. Option C. Proceed with the optimization by focusing exclusively on the projected financial benefits and operational efficiencies, assuming board approval will be a formality. Option D. Implement the process optimization immediately to capitalize on cost savings and efficiency gains, informing the board of the changes retrospectively. The correct answer is A. Present the proposed process optimization to the board's Risk and Audit Committee for review and approval before implementation. Explanation. This scenario presents a professional challenge because it requires the underwriting manager to balance the need for efficient operational processes with the fundamental principles of corporate governance, specifically regarding board oversight and accountability. The manager must ensure that the proposed process optimization does not inadvertently undermine the board's statutory responsibilities or create a perception of circumventing established governance structures. Careful judgment is required to identify a solution that enhances efficiency without compromising ethical standards or regulatory compliance. The correct approach involves the underwriting manager proactively engaging the board's Risk and Audit Committee to present the proposed process optimization. This approach is correct because it upholds the principle of board oversight, a cornerstone of corporate governance. By seeking committee input and approval, the manager demonstrates respect for the board's ultimate responsibility for strategic direction and risk management. This aligns with regulatory expectations that significant operational changes, especially those impacting risk profiles or internal controls, should be subject to appropriate board-level scrutiny. It also fosters transparency and ensures that any potential governance implications are identified and addressed early. An incorrect approach would be to implement the process optimization unilaterally without informing or seeking input from the board or its relevant committees. This fails to acknowledge the board's oversight role and can be interpreted as a disregard for established governance protocols. Such an action could lead to regulatory scrutiny for failing to ensure adequate board oversight of significant operational changes, potentially violating principles of accountability and transparency. Another incorrect approach would be to delegate the decision-making authority for this process optimization to a subcommittee without clear board mandate or oversight. While delegation can be efficient, it must be within the established governance framework. If the board has not explicitly empowered a subcommittee to make such decisions, or if the subcommittee's decision-making process lacks transparency and accountability to the full board, it undermines the principle of collective board responsibility and can lead to governance gaps. A third incorrect approach would be to focus solely on the cost-saving aspects of the optimization, without considering its impact on the company's risk management framework or the board's ability to fulfill its fiduciary duties. Corporate governance mandates that decisions, including process optimizations, must consider a broader range of factors beyond immediate financial benefits, including ethical implications, regulatory compliance, and the long-term sustainability of the business. Ignoring these aspects can lead to unintended consequences that negatively impact the company's reputation and regulatory standing. The professional decision-making process for similar situations should involve a systematic evaluation of any proposed change against the company's corporate governance framework, relevant laws, and ethical principles. This includes identifying key stakeholders, particularly the board and its committees, assessing potential impacts on risk management and internal controls, and ensuring transparency and accountability throughout the decision-making and implementation process. Proactive communication and seeking appropriate approvals are crucial for maintaining good corporate governance. Question 6. Stakeholder feedback indicates that a significant portion of our commercial insurance portfolio is concentrated among a few large buyers who consistently leverage their market position to negotiate highly favorable terms, often pushing the boundaries of standard coverage and pricing. As an associate in commercial underwriting management, what is the most appropriate strategic response to this persistent challenge? Option A. Lobby industry associations to advocate for regulatory caps on the extent to which buyers can negotiate insurance terms, citing concerns about market stability. Option B. Implement a tiered underwriting approach where buyers exhibiting strong bargaining power are automatically offered less comprehensive coverage options to protect the insurer's margins. Option C. Accept the negotiated terms as a necessary cost of doing business to maintain market share, focusing solely on increasing overall policy volume to offset any perceived margin erosion. Option D. Develop enhanced analytical models to quantify the impact of buyer bargaining power on profitability and risk, and adjust underwriting guidelines and pricing strategies accordingly, potentially exploring reinsurance options for concentrated risks. Correct answer is D. Develop enhanced analytical models to quantify the impact of buyer bargaining power on profitability and risk, and adjust underwriting guidelines and pricing strategies accordingly, potentially exploring reinsurance options for concentrated risks. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's need for profitable underwriting with the market reality of significant buyer bargaining power. Underwriters must assess the true risk and pricing implications of this power without compromising the insurer's financial stability or engaging in unfair practices. The OM designation implies a need for strategic thinking beyond basic risk assessment, incorporating market dynamics and stakeholder relationships within the regulatory framework. The correct approach involves a nuanced understanding of how buyer bargaining power impacts the insurance contract and the underwriting process. It requires the underwriter to proactively identify and quantify the influence of powerful buyers on policy terms, pricing, and coverage scope. This includes assessing the buyer's ability to negotiate favorable terms due to their market share, purchasing volume, or alternative market access. The underwriter must then adjust underwriting strategies, pricing models, and potentially seek reinsurance to mitigate the increased risk or reduced profitability associated with such power, all while adhering to the principles of fair treatment and solvency mandated by the regulatory framework. This proactive and data-driven approach ensures that the insurer remains competitive while maintaining sound financial practices. An incorrect approach would be to ignore or underestimate the impact of buyer bargaining power. This could lead to underpricing policies, offering inadequate coverage for the risk assumed, or failing to implement appropriate risk mitigation strategies. Such an oversight could result in financial losses for the insurer, potentially jeopardizing its solvency and ability to meet its obligations to all policyholders, which would be a direct violation of regulatory requirements designed to protect policyholders and maintain market stability. Another incorrect approach would be to capitulate entirely to buyer demands without proper risk assessment or consideration of the insurer's profitability. This could result in offering terms that are financially unsustainable, even if they secure immediate business. This approach fails to uphold the underwriter's fiduciary duty to the insurer and its stakeholders, and can lead to adverse selection and long-term financial detriment, contravening regulatory expectations for prudent management. Finally, an incorrect approach would be to engage in discriminatory pricing or coverage practices to offset the perceived disadvantage of buyer bargaining power. This would violate principles of fairness and equity and could lead to regulatory sanctions. The professional decision-making process should involve a thorough analysis of the buyer's influence, its quantifiable impact on risk and profitability, and the development of a strategy that aligns with the insurer's risk appetite and regulatory obligations. This includes open communication with stakeholders, leveraging data analytics, and potentially seeking expert advice to ensure a balanced and sustainable outcome. Question 7. The review process indicates that a commercial underwriting team has been observed sharing client proposal documents containing sensitive financial and personal information via unsecured email, leading to a potential data breach. Which of the following operational management responses best addresses this situation in compliance with regulatory frameworks governing data protection and client confidentiality? Option A. Implement a mandatory, recurring training program for all staff on data protection regulations and company policy regarding secure data handling, coupled with a review and update of the company's data security protocols and the introduction of secure file sharing software. Option B. Issue a verbal reminder to the underwriting team about the importance of client confidentiality and the risks associated with unsecured email, and instruct them to be more careful in the future. Option C. Advise the underwriting team to cease sharing any client documents via email altogether and to rely solely on in-person discussions for all sensitive information exchange. Option D. Conduct an immediate disciplinary review of the individuals involved in sharing the documents via unsecured email without investigating the underlying procedural or systemic causes. The correct answer is A. Implement a mandatory, recurring training program for all staff on data protection regulations and company policy regarding secure data handling, coupled with a review and update of the company's data security protocols and the introduction of secure file sharing software. Explanation: the review process indicates a potential breakdown in operational management skills related to the handling of sensitive client data within a commercial underwriting department. This scenario is professionally challenging because it requires balancing efficient operational processes with stringent data protection regulations and ethical obligations to clients. A failure in this area can lead to significant financial penalties, reputational damage, and loss of client trust. Careful judgment is required to identify the root cause and implement corrective actions that are both effective and compliant. The correct approach involves establishing and enforcing clear, documented procedures for data handling that align with regulatory requirements, such as those mandated by the General Data Protection Regulation, GDPR, if the jurisdiction is the UK or EU, or equivalent national data protection laws. This includes implementing access controls, data minimization principles, secure storage, and defined retention and destruction policies. This approach is right because it directly addresses the regulatory and ethical imperative to protect client confidentiality and personal data. It demonstrates a commitment to compliance, which is a fundamental responsibility of commercial underwriters and management. By proactively managing data security, the firm mitigates risks and upholds its duty of care. An incorrect approach of merely reminding staff about data security without implementing concrete procedural changes or technical safeguards is professionally unacceptable. This fails to address the systemic issues that may have led to the breach and relies on individual adherence rather than robust organizational controls, which is a common regulatory pitfall. It also neglects the need for demonstrable compliance and audit trails. Another incorrect approach of assuming the issue is isolated to a single individual without investigating broader systemic vulnerabilities or training gaps is also professionally unsound. This can lead to a recurrence of the problem and suggests a lack of due diligence in operational oversight. It can also create a culture of blame rather than a focus on continuous improvement. A third incorrect approach of prioritizing speed of underwriting over data security protocols, even if not explicitly stated, is highly problematic. This implicitly condones risky behavior and directly contravenes the principles of data protection by placing commercial expediency above legal and ethical obligations. This can result in severe regulatory sanctions and reputational damage. The professional decision-making process for similar situations should involve a systematic risk assessment, followed by the development and implementation of clear, actionable policies and procedures. This should be supported by regular training, ongoing monitoring, and a culture that prioritizes compliance and ethical conduct. When an issue arises, the focus should be on understanding the root cause, implementing corrective actions, and learning from the experience to prevent future occurrences. Question 8. The assessment process reveals that a technology startup is seeking comprehensive commercial insurance coverage for its newly patented software algorithm, which is still in beta testing. The underwriting team is tasked with valuing this intellectual property to determine appropriate coverage limits and premiums. Which valuation approach would best align with the principles of sound commercial underwriting and regulatory compliance in assessing the value of this early-stage, proprietary software? Option A. Projecting future revenue streams generated by the algorithm and discounting them back to present value without rigorous sensitivity analysis. Option B. Estimating value based on the aggregate costs incurred to date in research, development, and patent filing. Option C. Analyzing recent sales data of similar patented software algorithms in the market to establish a comparable value. Option D. Appraising the value based on the replacement cost of developing a functionally equivalent algorithm from scratch. The correct answer is B. Estimating value based on the aggregate costs incurred to date in research, development, and patent filing. Explanation. This scenario is professionally challenging because accurately valuing intellectual property, IP, for commercial underwriting requires a nuanced understanding of intangible assets, which are inherently difficult to quantify. Underwriters must balance the potential future value of IP with the inherent risks and uncertainties associated with its development, protection, and market adoption. Failure to do so can lead to mispriced premiums, inadequate coverage, or even the underwriting of uninsurable risks, impacting both the insurer's financial stability and the insured's ability to protect their valuable assets. Careful judgment is required to select an appropriate valuation methodology that reflects the specific nature of the IP and its commercial context, adhering strictly to the regulatory framework governing commercial insurance underwriting. The correct approach involves utilizing a market-based valuation methodology, specifically focusing on comparable transactions for similar IP assets. This method is preferred because it grounds the valuation in observable market data, providing a more objective and defensible assessment of the IP's worth. Regulatory frameworks for commercial underwriting emphasize the importance of sound actuarial principles and risk assessment, which are best served by valuations that reflect real-world market conditions and investor sentiment. This approach aligns with the principle of underwriting based on demonstrable risk and value, ensuring that premiums are commensurate with the potential exposure. An incorrect approach would be to rely solely on the cost-based valuation method, which calculates the IP's value based on the historical costs incurred in its development. This is problematic because it ignores the future revenue-generating potential and market demand for the IP, which are critical factors in its commercial value. Regulatory guidelines often caution against valuations that do not adequately consider future economic benefits. Another incorrect approach is to use an income-based valuation method without robust projections and sensitivity analysis for future cash flows. While income-based methods are relevant, an uncritical application that fails to account for the inherent volatility and uncertainty of future earnings from IP can lead to an inflated or deflated valuation, deviating from the prudent underwriting standards mandated by regulations. This can result in misrepresentation of risk and value, potentially violating principles of fair dealing and accurate risk assessment. Professionals should employ a decision-making framework that prioritizes a thorough understanding of the IP's nature, its stage of development, its competitive landscape, and its potential for commercialization. This involves gathering comprehensive data, consulting with IP experts where necessary, and selecting a valuation methodology that is most appropriate for the specific asset and its intended use. The chosen method should be transparent, justifiable, and consistent with regulatory expectations for prudent underwriting and risk management. A critical step is to perform sensitivity analysis to understand how different assumptions impact the valuation, thereby informing risk assessment and coverage decisions. Question 9. Assessment of a commercial underwriter's ethical responsibility when faced with intense market competition, where a rival insurer is perceived to be gaining market share through aggressive, potentially misleading marketing tactics and aggressive pricing that may not fully reflect underlying risk. The underwriter is considering responding by highlighting perceived weaknesses in the competitor's product offerings and suggesting to brokers that the competitor's pricing is unsustainable, aiming to regain market share. Option A. Focus on developing superior underwriting practices, product innovation, and transparent pricing strategies to differentiate the company's offerings and attract business based on merit and value. Option B. Launch a marketing campaign that exaggerates the benefits of the company's own products while subtly implying that competitor products are inadequate without making direct, verifiable claims. Option C. Publicly question the financial solvency and underwriting integrity of the competitor, citing anecdotal evidence from brokers to suggest their pricing is unsustainable and their products are inferior. Option D. Offer brokers undisclosed incentives or preferential treatment for directing business away from the competitor, framing it as a loyalty program. The correct answer is A. Focus on developing superior underwriting practices, product innovation, and transparent pricing strategies to differentiate the company's offerings and attract business based on merit and value. Explanation: this scenario presents a professional challenge because it forces an underwriter to balance competitive pressures with ethical obligations and regulatory compliance. The temptation to gain a market advantage through potentially misleading or unfair practices is significant, but it directly conflicts with the principles of fair dealing and market integrity that are fundamental to commercial insurance regulation. Careful judgment is required to navigate this conflict, ensuring that business objectives do not override ethical and legal responsibilities. The correct approach involves prioritizing transparency and fair competition. This means refraining from any action that could be construed as predatory or deceptive, even if it offers a short-term competitive edge. Specifically, it requires the underwriter to focus on developing superior products, service, and pricing based on sound underwriting principles, rather than on undermining competitors through unethical means. This aligns with the overarching regulatory framework that promotes a stable and competitive insurance market where participants act with integrity. The ethical justification lies in upholding the trust placed in the insurance profession by policyholders and the market as a whole. An incorrect approach that involves disseminating unsubstantiated negative information about a competitor's financial stability or product offerings is ethically reprehensible and likely violates regulations concerning unfair trade practices and misrepresentation. Such actions erode market confidence and can lead to significant regulatory penalties. Another incorrect approach, such as offering undisclosed inducements or rebates to brokers to steer business away from competitors, constitutes a form of bribery or undue influence. This not only distorts the competitive landscape by prioritizing relationships over merit, but also violates regulations designed to ensure that policyholder interests are paramount and that all transactions are conducted on a level playing field. A further incorrect approach, such as engaging in aggressive, misleading advertising that exaggerates one's own product benefits while downplaying or misrepresenting competitor products, is a form of deceptive advertising. This violates regulations that mandate truthful and non-misleading communications to consumers and business partners, undermining fair competition and consumer choice. The professional decision-making process for similar situations should involve a clear ethical compass, grounded in regulatory requirements. Underwriters should first identify the core ethical and regulatory principles at play. They should then evaluate each potential competitive strategy against these principles, asking whether the strategy promotes fair competition, transparency, and the best interests of policyholders. If a strategy raises concerns about potential deception, unfair advantage, or regulatory breach, it should be rejected. Seeking guidance from legal counsel or compliance departments is also a crucial step when in doubt. The ultimate goal is to achieve competitive success through legitimate means that strengthen the market and uphold professional integrity. Question 10. Upon reviewing the financial statements of a prospective commercial insurance client, an underwriter is tasked with assessing the company's financial stability and its capacity to manage potential liabilities. The underwriter has identified that the company's net income has been positive for the past 3 years, but the cash flow from operations has been declining. Which approach to analyzing the cash flow statement would best inform the underwriter's decision regarding the client's risk profile? Option A: giving significant weight to the financing activities section to gauge the company's debt levels and its ability to secure additional funding. Option B: relying solely on the reported net income figures, assuming that positive net income directly correlates with strong financial health and liquidity. Option C: primarily examining the investing activities section to understand the company's capital expenditure plans and their impact on future cash generation. Option D: focusing on the trend of operating cash flow in conjunction with net income to identify potential discrepancies and assess the sustainability of earnings. The correct answer is D: focusing on the trend of operating cash flow in conjunction with net income to identify potential discrepancies and assess the sustainability of earnings. Explanation: this scenario is professionally challenging because the underwriter must interpret a company's financial health not just through static balance sheets and income statements, but by understanding the dynamic flow of cash. Misinterpreting the cash flow statement can lead to mispricing risk, offering inadequate coverage, or even insuring a company that is fundamentally unstable, potentially leading to claims the insurer cannot cover. The OM designation implies a need for sophisticated underwriting decisions that go beyond basic financial analysis. The correct approach involves analyzing the cash flow statement to understand the sources and uses of cash across operating, investing, and financing activities. This provides insight into the company's ability to generate cash from its core business, fund its growth, and meet its debt obligations. A strong operating cash flow is a key indicator of a healthy, sustainable business. Regulatory frameworks for commercial underwriting, while not always explicitly detailing cash flow statement analysis techniques, emphasize prudent risk assessment and the need for underwriters to possess sufficient knowledge to make informed decisions. Ethical considerations also demand that underwriters act in the best interest of their company by accurately assessing risk, which includes a thorough understanding of a company's financial viability as evidenced by its cash flow. An incorrect approach would be to solely focus on reported net income without considering the underlying cash generation. Net income can be influenced by accounting accruals and non-cash expenses, which do not reflect actual cash availability. This fails to address the company's liquidity and its ability to meet short-term obligations, a critical factor in underwriting. Another incorrect approach is to only examine the financing activity section. While important for understanding how a company funds itself, an over-reliance on this section can mask underlying operational weaknesses if the company is merely borrowing to stay afloat, rather than generating cash from its operations. This ignores the fundamental sustainability of the business. Finally, neglecting to compare cash flow trends over multiple periods is also an incorrect approach. A single period's cash flow statement can be misleading. Analyzing trends reveals whether cash generation is improving, declining, or stable, providing a more robust picture of financial health. This lack of historical perspective can lead to short-sighted underwriting decisions. Professionals should employ a decision-making framework that prioritizes a holistic view of financial health. This involves understanding the interrelationships between the income statement, balance sheet, and cash flow statement. Specifically for cash flow analysis, the framework should emphasize 1. Assessing the quality of earnings by reconciling net income to operating cash flow. 2. Evaluating the sustainability of cash flows from operations. 3. Understanding how investing activities support or detract from future cash generation. And 4. Analyzing financing activities to determine the company's reliance on external funding and its ability to service debt. This comprehensive approach ensures a more accurate risk assessment, aligning with both regulatory expectations for prudent underwriting and ethical obligations to stakeholders. Question 11. Cost-benefit analysis shows that obtaining a specialized, independent appraisal for a fleet of advanced manufacturing robots would be significantly more expensive and time-consuming than using a generalist appraiser or relying on the insured's depreciated book value. However, the potential for significant underinsurance or overinsurance due to the rapid technological advancements and specialized market for these robots is a considerable risk. Which approach best aligns with prudent underwriting practices and regulatory expectations for insuring such assets? Option A. Utilize a generalist equipment appraiser who has experience with industrial machinery but not specifically with advanced robotics. Option B. Accept the insured's stated replacement cost for the robots, as this represents their perceived value. Option C. Engage a qualified, independent third-party appraiser with specific expertise in advanced manufacturing robotics to conduct a current market value appraisal. Option D. Rely on the depreciated book value provided by the insured, assuming it reflects a reasonable estimate of current worth. The correct answer is C. Engage a qualified, independent third-party appraiser with specific expertise in advanced manufacturing robotics to conduct a current market value appraisal. Explanation: this scenario presents a professional challenge because the underwriter must balance the need for accurate valuation of specialized equipment against the practicalities of cost and time constraints. The underwriter's responsibility is to ensure the insured value accurately reflects the equipment's worth to prevent underinsurance or overinsurance, both of which have significant financial implications for the insurer and the insured. The pressure to expedite the underwriting process can lead to shortcuts that compromise the integrity of the appraisal. Careful judgment is required to select an appraisal method that is both cost-effective and sufficiently robust to meet regulatory and internal policy requirements. The correct approach involves engaging a qualified, independent third-party appraiser with specific expertise in the type of equipment being insured. This method is correct because it leverages specialized knowledge and ensures an objective valuation, which is crucial for accurate risk assessment and premium calculation. Regulatory frameworks, such as those governing commercial insurance underwriting, often implicitly or explicitly require that valuations be based on sound appraisal principles and conducted by competent individuals. Relying on an independent expert mitigates potential conflicts of interest and provides a defensible valuation should a claim arise. This aligns with the ethical duty of care owed to both the insured and the insurer, ensuring fair treatment and financial prudence. An incorrect approach would be to rely solely on the insured's provided purchase price without independent verification. This is ethically problematic as it places undue trust in the insured's potentially biased information and fails to account for depreciation, obsolescence, or market fluctuations. It also risks violating regulatory requirements that mandate due diligence in valuation. Another incorrect approach is to use a generic, non-specialized appraisal method for highly technical equipment. This fails to capture the unique characteristics and market value of specialized assets, leading to an inaccurate valuation and potentially exposing the insurer to significant losses or the insured to inadequate coverage. This demonstrates a lack of professional competence and adherence to underwriting best practices. Professionals should approach such situations by first identifying the specific type and complexity of the equipment. They should then consult internal underwriting guidelines and relevant regulatory requirements regarding valuation. If the equipment is specialized or high value, engaging an independent, qualified appraiser should be the default. A cost-benefit analysis should then consider the cost of the appraisal against the potential financial exposure from an inaccurate valuation. Documenting the rationale for the chosen appraisal method and any assumptions made is also critical for auditability and future reference. Question 12. Performance analysis shows a consistent trend of high-value commercial client requesting credit terms that fall outside the established parameters of the company's credit policy. The underwriting team is under pressure to maintain client relationships and meet growth targets. A specific proposal involves extending credit to a long-standing client whose financial projections, while optimistic, present a higher risk profile than typically accepted under current policy guidelines. The underwriter must decide whether to approve this exception. Which of the following approaches best demonstrates professional judgment and adherence to regulatory expectations for credit policy compliance? Option A. Approve the credit extension based on the underwriter's personal assessment of the client's character and past performance, bypassing formal policy review to expedite the process. Option B. Approve the credit extension, documenting the client's historical loyalty and potential for future business as justification for the exception, and inform senior management of the deviation. Option C. Deny the credit extension outright due to the deviation from policy, without further investigation or consideration of mitigating factors. Option D. Conduct a comprehensive risk assessment of the proposed credit extension, evaluating its alignment with the underlying principles of the credit policy, seeking input from the risk management department, and documenting the rationale for approval or denial, including any agreed-upon mitigating controls. The correct answer is B. Approve the credit extension, documenting the client's historical loyalty and potential for future business as justification for the exception, and inform senior management of the deviation. Explanation. This scenario is professionally challenging because it requires balancing the need for business growth with strict adherence to established credit policies, which are designed to mitigate risk and ensure regulatory compliance. The underwriter must exercise sound judgment to determine if an exception is warranted without compromising the integrity of the credit policy or exposing the company to undue risk. The pressure to meet targets can create a conflict of interest, making objective decision-making paramount. The correct approach involves a thorough review of the proposed exception against the spirit and letter of the credit policy, seeking input from relevant stakeholders, and documenting the rationale for any decision. This ensures that any deviation from policy is justified, transparent, and aligns with the company's risk appetite and regulatory obligations. Specifically, it requires understanding the underlying principles of the credit policy, assessing the specific risks associated with the proposed exception, and ensuring that appropriate mitigating controls are in place. This aligns with the principles of prudent underwriting and good corporate governance, which are implicitly or explicitly mandated by regulatory frameworks governing financial institutions. An incorrect approach that involves approving the exception solely based on the client's historical relationship and potential for future business, without a rigorous assessment of the policy's applicability and risk, fails to uphold the credit policy. This can lead to regulatory scrutiny for noncompliance with internal controls and risk management frameworks. Another incorrect approach, which is to deny the exception without a proper review or consideration of mitigating factors, might stifle legitimate business opportunities and could be seen as inflexible. But the primary failure lies in not engaging in a proper decision-making process that considers all relevant factors and policy guidelines. Proving the exception without proper documentation or justification, even if the risk is deemed acceptable, represents a failure in internal controls and auditability, which are critical components of regulatory compliance. Professionals should employ a structured decision-making framework that begins with a clear understanding of the relevant policies and regulations. This involves identifying the core issue, gathering all necessary information, evaluating potential solutions against policy and risk appetite, consulting with appropriate parties, e.g., senior management, legal, risk departments, making a well-reasoned decision, and meticulously documenting the entire process and rationale. This systematic approach ensures that decisions are objective, defensible, and compliant. Question 13. Implementation of a new fleet insurance policy for a commercial trucking company requires the underwriter to determine the valuation of a specialized, custom-built refrigerated trailer. The insured has provided a purchase invoice from 3 years ago and a current estimate from a local repair shop that performed minor maintenance last year. The underwriter is aware that similar standard trailers have depreciated significantly in the market over the past 3 years, but this custom trailer has unique features that may affect its value. Which of the following approaches to asset valuation is most appropriate for this scenario, considering the need for accurate risk assessment and regulatory compliance? Option A. Apply a standard depreciation schedule for commercial trailers without considering the trailer's unique customization or current market demand for such specialized assets. Option B. Rely solely on the estimate provided by the local repair shop, as it reflects recent assessment of the trailer's condition. Option C. Utilize a valuation method that considers the asset's replacement cost, adjusted for depreciation based on its age and condition, and incorporates market data for comparable specialized trailers, if available, or expert appraisal to account for unique features. Option D. Accept the insured's stated value based on the original purchase invoice, assuming the unique features offset any market depreciation. The correct answer is C. Utilize a valuation method that considers the asset's replacement cost, adjusted for depreciation based on its age and condition, and incorporates market data for comparable specialized trailers, if available, or expert appraisal to account for unique features. Explanation. This scenario presents a professional challenge because the underwriter must determine the appropriate valuation method for a specialized commercial asset, balancing the need for accurate risk assessment with the practicalities of available information and market conditions. The OM designation implies a need for sophisticated judgment beyond simple data entry, requiring an understanding of how asset valuation directly impacts premium, coverage limits, and the insurer's overall financial exposure. The challenge lies in selecting a method that is both compliant with regulatory expectations for prudent underwriting and reflective of the asset's true economic value, thereby preventing adverse selection and ensuring fair pricing. The correct approach involves utilizing a valuation method that is widely accepted within the industry for similar assets and is supported by objective, verifiable data. This typically means employing a method that considers the asset's replacement cost, its market value, or its income-generating potential, depending on the asset's nature and intended use. For example, if the asset is a piece of machinery, replacement cost less depreciation might be appropriate. If it's a commercial property, market value derived from comparable sales or an income capitalization approach might be more suitable. The regulatory framework for commercial underwriting, as exemplified by the principles guiding the OM designation, emphasizes the importance of accurate risk assessment, which is fundamentally tied to sound asset valuation. This approach ensures that the insurer is not overinsuring or underinsuring the asset, thereby adhering to principles of fairness, solvency, and responsible risk management. An incorrect approach would be to rely solely on the insured's stated value without independent verification. This fails to meet the underwriter's duty of due diligence and can lead to significant financial misstatements. Regulators expect underwriters to exercise independent judgment and not simply accept information provided by the applicant at face value, especially when it directly impacts the insurer's financial exposure. Another incorrect approach would be to use a valuation method that is not standard for the specific asset class or is based on subjective or speculative factors. This introduces an unacceptable level of uncertainty and can result in premiums that do not adequately reflect the risk, potentially leading to financial instability for the insurer and non-compliance with solvency requirements. A third incorrect approach would be to ignore the asset's condition or obsolescence when determining its value. This would result in an inflated valuation, leading to overinsurance and an unfair premium, which is contrary to the principles of sound underwriting and fair competition. Professional decision-making in similar situations requires a systematic process. First, understanding the nature of the asset and its intended use. Second, identifying the most appropriate valuation methodologies for that asset class. Third, gathering objective and verifiable data to support the chosen method. And fourth, critically evaluating the data and the resulting valuation to ensure it is reasonable and aligns with regulatory expectations for prudent underwriting. This involves a continuous learning process to stay abreast of industry best practices and valuation standards. Question 14. Which approach would be most appropriate for an underwriter when a long-standing client requests coverage for a new venture that presents a significantly higher risk profile than their previous operations, and the client expresses urgency due to a pending business deal? Option A. Decline the coverage outright without further investigation, citing the increased risk as a general concern. Option B. Conduct a comprehensive risk assessment based on established underwriting guidelines, gather all necessary information, and make a decision based on the objective evaluation of the risk, communicating the rationale clearly to the client. Option C. Offer a significantly higher premium without a detailed risk assessment, assuming the client will accept it due to their urgency. Option D. Immediately approve the coverage to maintain the client relationship and meet their urgent request, deferring a detailed risk assessment until after the deal closes. Correct answer is D. Immediately approve the coverage to maintain the client relationship and meet their urgent request, deferring a detailed risk assessment until after the deal closes. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate desires and the underwriter's responsibility to ensure the long-term viability and ethical soundness of the insurance contract. The underwriter must balance client relationship management with adherence to underwriting principles and regulatory compliance. Careful judgment is required to avoid adverse selection, moral hazard, and potential regulatory breaches. The correct approach involves a thorough and objective assessment of the risk, adhering strictly to established underwriting guidelines and regulatory requirements. This means gathering all necessary information, evaluating the risk based on objective criteria, and making a decision that aligns with the insurer's risk appetite and the principles of sound underwriting. This approach is ethically justified because it upholds the principle of fairness to all policyholders by ensuring premiums reflect the actual risk, and it prevents the insurer from taking on unacceptable levels of exposure. It also aligns with regulatory expectations that insurers operate prudently and avoid practices that could destabilize the market or lead to financial distress. An incorrect approach that prioritizes client satisfaction over objective risk assessment would be ethically and regulatorily flawed. This could lead to the acceptance of risks that are poorly understood or inadequately priced, potentially resulting in future claims that exceed expectations and financial losses for the insurer. Such a practice could also be seen as discriminatory if it leads to preferential treatment not based on risk factors. Furthermore, it could violate principles of good faith and fair dealing if the insurer knowingly accepts a risk it cannot adequately manage or price, potentially misleading the client about the true nature of the coverage. Another incorrect approach, that of outright refusal without a clear, documented, and justifiable reason based on underwriting guidelines, is also problematic. While the underwriter must be firm in rejecting unacceptable risks, the refusal must be transparent and based on objective criteria. A refusal without a sound, demonstrable basis can damage client relationships and, in some jurisdictions, could be challenged if it appears arbitrary or discriminatory. It fails to demonstrate due diligence in risk assessment. The professional decision-making process for similar situations should involve a structured approach. First, clearly identify the underwriting guidelines and relevant regulations applicable to the risk. Second, gather all pertinent information about the applicant and the proposed coverage. Third, objectively assess the risk against the established criteria, identifying any deviations or red flags. Fourth, consult with senior underwriters or management if the situation is complex or falls outside standard guidelines. Fifth, document the decision-making process thoroughly, including the rationale for acceptance, declination, or modification of terms. Finally, communicate the decision clearly and professionally to the client or broker, providing a well-reasoned explanation if necessary. Question 15. The analysis reveals that a commercial underwriter is meeting with a prospective client who has a complex manufacturing operation. The client has expressed general concerns about business interruption and product liability, but has not provided specific details about their operational risks or their existing insurance arrangements. The underwriter needs to communicate the potential policy options effectively. Which communication approach best aligns with regulatory expectations for client engagement and policy explanation in this scenario? Option A. Present a policy document filled with technical insurance terminology and complex clauses, expecting the client to interpret its meaning and implications for their business. Option B. Briefly mention that the policy covers business interruption and product liability, and then focus on the premium cost, assuming the client is knowledgeable about insurance. Option C. Provide a standard overview of common commercial insurance policies, highlighting general coverage for business interruption and product liability, and assume the client will ask for clarification if needed. Option D. Proactively ask detailed questions about the client's specific manufacturing processes, supply chain, and risk management strategies to tailor the policy discussion to their unique needs. The correct answer is D. Proactively ask detailed questions about the client's specific manufacturing processes, supply chain, and risk management strategies to tailor the policy discussion to their unique needs. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need for clear, concise communication with the regulatory obligation to provide accurate and complete information to a client. Misinterpreting or omitting crucial details can lead to misunderstandings, financial losses for the client, and potential regulatory sanctions for the insurer. The underwriter must exercise careful judgment to ensure that their communication is both effective and compliant. The correct approach involves proactively seeking clarification from the client regarding their specific needs and concerns before presenting a policy. This demonstrates a commitment to understanding the client's situation, which is a cornerstone of good client service and aligns with the principles of fair treatment of customers. By asking targeted questions, the underwriter can tailor their communication to address the client's unique requirements, ensuring that the policy's terms, conditions, and exclusions are explained in a way that is easily understood and relevant to their business. This proactive engagement helps to prevent future disputes and reinforces the insurer's reputation for professionalism and integrity. An incorrect approach that involves providing a generic policy overview without understanding the client's specific business operations fails to meet the client's needs and may lead to the client purchasing a policy that is not fit for purpose. This could be seen as a failure to act in the client's best interests and could violate principles of good conduct and fair dealing, potentially leading to regulatory scrutiny. Another incorrect approach that involves using highly technical insurance jargon without explanation risks confusing the client and obscuring important policy details. This lack of clarity can lead to the client misunderstanding their coverage, which is a failure of communication, and could result in a breach of regulatory expectations regarding transparency and client understanding. A further incorrect approach that involves assuming the client understands all aspects of commercial insurance without verification is also problematic. This assumption can lead to critical information being overlooked or misunderstood, potentially leaving the client exposed to unforeseen risks. Professional decision-making in such situations requires a structured approach. First, actively listen to and understand the client's stated needs and concerns. Second, ask clarifying questions to fill any information gaps and confirm understanding. Third, tailor the communication of policy details to the client's level of understanding, using clear and accessible language. Finally, document the communication and any agreed-upon actions to ensure accountability and provide a record of the interaction. Question 16. The monitoring system demonstrates a consistent pattern of elevated readings for volatile organic compounds, VOC, in soil vapor samples collected from the perimeter of a commercial warehouse property being considered for a comprehensive property insurance policy. The property has a history of industrial use, including solvent storage and manufacturing. As the underwriter responsible for assessing this risk, which of the following actions best aligns with prudent environmental due diligence practices and regulatory expectations for commercial underwriting? Option A. Engage a qualified environmental consultant to conduct a Phase I environmental site assessment, ESSA, to investigate the potential sources and extent of the VOC contamination and to evaluate associated risks. Option B. Issue the policy with a broad environmental exclusion clause, effectively transferring all environmental liability to the insured, and defer any further investigation until a claim arises. Option C. Proceed with underwriting the policy based on the seller's verbal assurance that the property has no known environmental issues and that the elevated readings are likely due to off-site sources. Option D. Conduct a brief visual inspection of the property yourself to determine if any obvious signs of contamination are present before making an underwriting decision. The correct answer is A. Engage a qualified environmental consultant to conduct a Phase I environmental site assessment, ESSA, to investigate the potential sources and extent of the VOC contamination and to evaluate associated risks. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the need for comprehensive risk assessment with the practicalities of commercial transactions, specifically concerning environmental liabilities. The underwriter must navigate potential environmental contamination risks that could significantly impact the insured property's value and the insurer's exposure. Careful judgment is required to ensure that the underwriting decision is informed by adequate due diligence without unduly delaying or derailing a legitimate business transaction. The OM designation implies a need for a sophisticated understanding of risk management principles, including the identification and mitigation of environmental exposures within the commercial insurance context. The correct approach involves engaging a qualified environmental consultant to conduct a Phase I environmental site assessment, ESSA. This approach is professionally sound and ethically justifiable because it adheres to established industry standards for environmental due diligence. Regulatory frameworks, such as those guiding environmental risk management in commercial property transactions, often implicitly or explicitly recommend or require such assessments to identify potential pre-existing environmental conditions. Ethically, this approach demonstrates a commitment to informed decision-making and responsible risk underwriting, protecting both the insurer and, indirectly, the insured from unforeseen environmental liabilities. Provides a structured, evidence-based method for evaluating environmental risks. An incorrect approach would be to rely solely on the seller's assurances regarding the property's environmental condition. This is professionally unacceptable because it bypasses the critical independent verification necessary for accurate risk assessment. It represents an ethical failure by not conducting adequate due diligence, potentially exposing the insurer to significant unknown liabilities. Such an approach neglects the fundamental principle of underwriting, which is to assess and price risk based on reliable information. Another incorrect approach would be to proceed with underwriting based on a cursory visual inspection by the underwriter without engaging specialized expertise. This is professionally deficient because it lacks the technical depth required to identify subtle or historical environmental contamination. It is an ethical lapse as it demonstrates a disregard for the potential severity of environmental risks and a failure to uphold the duty of care expected of a professional underwriter. A further incorrect approach would be to postpone the environmental assessment indefinitely until after policy inception. This is professionally unsound, as it places the insurer at immediate risk without a proper understanding of the potential environmental exposures. It is an ethical failing because it knowingly accepts risk without adequate information, potentially leading to claims that could have been mitigated or priced appropriately had the due diligence been performed proactively. The professional decision-making process for similar situations should involve a systematic risk assessment framework. This begins with identifying potential environmental risks based on the property's location, history, and current use. Following identification, the underwriter should determine the appropriate level of due diligence required, often escalating from a basic review to a Phase I ESA, and potentially a Phase Roman II ESA if warranted. The decision to engage external experts like environmental consultants is a critical step in ensuring that the assessment is thorough and objective. The underwriter must then integrate the findings of the due diligence into the underwriting decision, adjusting terms, conditions, or pricing as necessary, or declining coverage if the risks are unmanageable. This process emphasizes proactive risk management and informed decision-making. Question 17. Stakeholder feedback indicates a growing concern from the underwriting management team regarding the perceived slowness of the commercial underwriting process, leading to missed business opportunities. The underwriting team, however, feels that current processing times are necessary to ensure thorough risk assessment and adherence to underwriting guidelines. Which of the following approaches best addresses this situation while adhering to sound underwriting principles and regulatory expectations? Option A. Focus solely on investing in new technology solutions to automate underwriting decisions, assuming this will inherently speed up the process and improve efficiency. Option B. Conduct a comprehensive review of the underwriting workflow, involving the underwriting team in identifying specific bottlenecks and proposing practical solutions for efficiency improvements without compromising risk assessment quality. Option C. Immediately implement a new policy mandating a 20% reduction in average policy turnaround time across all commercial lines of business. Option D. Prioritize processing high-volume, low-complexity applications to increase overall throughput, deferring detailed review of more complex risks until later. The correct answer is B. Conduct a comprehensive review of the underwriting workflow, involving the underwriting team in identifying specific bottlenecks and proposing practical solutions for efficiency improvements without compromising risk assessment quality. Explanation. Scenario analysis. This scenario presents a professional challenge stemming from differing interpretations of the underwriting workflow's efficiency and effectiveness between underwriting management and the frontline underwriting team. Management's focus on speed and volume, driven by business objectives, may overlook the nuanced risks and detailed analysis required by underwriters. Conversely, underwriters' emphasis on thoroughness, while crucial for risk selection, could be perceived as slowing down the process. This divergence necessitates a balanced approach that respects both the need for efficient operations and the imperative of sound underwriting judgment, all within the established regulatory framework. The challenge lies in reconciling these perspectives without compromising regulatory compliance or the quality of underwriting decisions. Correct approach analysis. The correct approach involves a collaborative review of the underwriting workflow, focusing on identifying bottlenecks and inefficiencies through data analysis and direct consultation with the underwriting team. This approach is right because it acknowledges the value of both management's strategic oversight and the underwriter's practical experience. By engaging the underwriting team in identifying specific process improvements, it fosters buy-in and ensures that solutions are practical and address the root causes of delays or perceived inefficiencies. This aligns with regulatory expectations for a well-managed and effective underwriting function, which implicitly requires processes that are both efficient and robust enough to ensure compliance with underwriting guidelines and risk appetite. Ethically, it demonstrates respect for the expertise of the underwriting staff and promotes a culture of continuous improvement. Incorrect approach is analysis. Implementing a blanket mandate for faster turnaround times without understanding the underlying causes of current processing speeds is an incorrect approach. This fails to address potential systemic issues within the workflow and could lead to rushed decisions, increased errors, and a higher likelihood of adverse selection, potentially violating underwriting guidelines and regulatory requirements for due diligence. Focusing solely on increasing the volume of policies processed without a corresponding review of underwriting quality or risk assessment is also an incorrect approach. It prioritizes quantity over quality, which can lead to the acceptance of unacceptable risks and a breach of the insurer's underwriting philosophy and risk appetite. Regulators expect insurers to manage their underwriting functions prudently, which includes maintaining appropriate risk selection standards. Adopting a purely reactive approach, addressing issues only when they lead to significant financial losses or regulatory scrutiny, is an incorrect approach. This demonstrates a lack of proactive risk management and a failure to implement a robust, forward-looking underwriting process. Regulatory frameworks often emphasize the importance of proactive risk management and internal controls to prevent issues before they arise. Professional reasoning. Professionals should approach such situations by first seeking to understand the differing perspectives. This involves active listening and data gathering. A structured approach would involve 1. Defining the problem clearly, acknowledging all stakeholder viewpoints. 2. Gathering objective data on workflow performance, including turnaround times, error rates, and reasons for delays. 3. Facilitating open dialogue with the underwriting team to understand their challenges and suggestions for improvement. 4. Developing a revised workflow that balances efficiency with risk assessment rigor, ensuring alignment with regulatory requirements and the company's risk appetite. 5. Implementing the revised workflow with clear communication and providing necessary training and resources. 6. Establishing a system for ongoing monitoring and feedback to ensure continued effectiveness and compliance. Question 18. Operational review demonstrates a significant opportunity to expand into a new commercial market segment, with the sales team projecting substantial new business volume. However, the underwriting department has limited historical data and expertise in this specific segment. What is the most prudent approach for the underwriting management to take? Option A. Conduct a thorough risk assessment of the new market segment. Develop appropriate underwriting guidelines and pricing strategies based on available data and industry best practices, and implement a phased rollout with close monitoring. Option B. Delegate the responsibility of developing underwriting criteria for the new segment entirely to the sales department, allowing them to set the terms for new business. Option C. Immediately reject the opportunity due to the lack of internal data and expertise, prioritizing the avoidance of any potential new risks. Option D. Authorize the sales team to proceed with aggressive marketing and sales efforts in the new segment, trusting their projections and assuming that any initial losses will be manageable. The correct answer is A. Conduct a thorough risk assessment of the new market segment. Develop appropriate underwriting guidelines and pricing strategies based on available data and industry best practices, and implement a phased rollout with close monitoring. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the immediate need for business growth with the long-term implications of underwriting practices and regulatory compliance. The pressure to meet targets can lead to a temptation to relax underwriting standards, which, if not managed carefully, can result in increased claims, financial losses, and regulatory scrutiny. The underwriter must exercise sound judgment to ensure that business objectives are pursued ethically and within the bounds of regulatory requirements. The correct approach involves a thorough, data-driven assessment of the proposed new market segment. This includes analyzing historical loss data for similar segments, understanding the specific risks associated with the new market, and developing appropriate underwriting guidelines and pricing models that reflect these risks. This approach is correct because it aligns with the fundamental principles of prudent underwriting, which mandate that risks be adequately understood, priced, and managed. Furthermore, it adheres to regulatory expectations that insurers operate on a sound financial basis and do not expose themselves to undue risk. Specifically, in the context of the Associate in Commercial Underwriting Management (OM) framework, this reflects a commitment to responsible risk selection and portfolio management, ensuring the long-term solvency and reputation of the underwriting operation. An incorrect approach would be to proceed with the new market segment based solely on the sales team's projections and without conducting a comprehensive risk assessment. This fails to acknowledge the potential for unforeseen losses and could lead to adverse selection, where the insured risks are significantly worse than anticipated. This approach is ethically questionable as it prioritizes short-term gains over the financial stability of the underwriting operation and the protection of policyholders. It also carries significant regulatory risk, as regulators expect insurers to have robust risk management frameworks in place. Another incorrect approach would be to implement overly restrictive underwriting guidelines that effectively preclude entry into the new market, despite the potential for profitable business. While this avoids risk, it stifles growth and innovation, potentially missing valuable opportunities. This approach, while seemingly risk-averse, can be detrimental to the business's competitive position and long-term viability. It may also indicate a lack of understanding of market dynamics and the ability to adapt underwriting strategies to new opportunities. A third incorrect approach would be to delegate the entire decision-making process to the sales department without adequate oversight from underwriting management. This undermines the core function of underwriting, which is to assess and manage risk, can lead to a misalignment of objectives, where sales targets overshadow sound risk management principles, potentially resulting in the acceptance of unacceptable risks. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the business objective e.g., market expansion. Second, conduct a comprehensive risk assessment of the proposed venture, gathering all relevant data and expert opinions. Third, develop underwriting strategies, including guidelines and pricing, that adequately address the identified risks. Fourth, establish clear performance metrics and monitoring mechanisms to track the success and profitability of the new venture. Finally, maintain open communication between underwriting, sales, and senior management to ensure alignment and address any emerging issues promptly. Question 19. The audit findings indicate a significant divergence between the insured's documented safety protocols and the observed operational practices on site, particularly concerning the handling of hazardous materials. As the underwriter responsible for this commercial liability account, what is the most appropriate course of action to ensure accurate risk assessment and policy compliance? Option A. Immediately issue a policy cancellation notice due to the insured's failure to adhere to their stated safety protocols. Option B. Renew the policy with the existing terms and conditions, assuming the audit findings represent minor, isolated incidents that do not materially affect the overall liability risk. Option C. Impose a substantial premium increase and add a broad exclusion for any claims related to hazardous material handling without further investigation into the root cause of the discrepancies. Option D. Initiate a detailed investigation to understand the reasons for the operational discrepancies, engage with the insured to discuss the findings and potential solutions, and assess the impact on the current liability exposure and policy terms. The correct answer is D. Initiate a detailed investigation to understand the reasons for the operational discrepancies, engage with the insured to discuss the findings and potential solutions, and assess the impact on the current liability exposure and policy terms. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the underwriter to balance the need for accurate risk assessment with the potential for contractual disputes and regulatory scrutiny. The audit findings highlight a discrepancy between the insured's stated operational practices and the actual implementation, directly impacting the assessment of liability exposure. Failure to address this discrepancy rigorously could lead to underpricing the risk, inadequate coverage, or even claims disputes later. The underwriter must exercise sound judgment to ensure the policy accurately reflects the risk and complies with all applicable regulations. Correct approach analysis. The correct approach involves a thorough investigation to reconcile the audit findings with the existing policy terms and the insured's representations. This includes engaging with the insured to understand the reasons for the discrepancies, reviewing relevant operational documentation, and potentially seeking expert advice. The justification lies in the fundamental principles of underwriting and insurance regulation, which mandate that policies be based on accurate risk assessment and that insurers act with due diligence. Specifically, this approach aligns with the regulatory requirement to underwrite risks prudently and to ensure that policy terms accurately reflect the exposures being covered. It also upholds the ethical obligation to be transparent and fair to both the insured and the insurer. Incorrect approaches analysis. One incorrect approach is to dismiss the audit findings as minor operational variances without further investigation. This fails to acknowledge the potential for these variances to significantly alter the liability profile of the insured. It represents a regulatory failure by not conducting due diligence and an ethical failure by potentially exposing the insurer to unforeseen risks and the insured to inadequate coverage. Another incorrect approach is to immediately increase premiums or impose restrictive endorsements without a clear understanding of the root cause of the discrepancies. While a response is necessary, an uninvestigated, punitive reaction can be seen as unfair to the insured and may not address the underlying operational issues. This could lead to regulatory complaints regarding unfair practices and damage the insurer-insured relationship. A third incorrect approach is to simply renew the policy as is, ignoring the audit findings. This is a direct abdication of the underwriter's responsibility to assess and manage risk. It constitutes a significant regulatory failure, as it violates the principle of prudent underwriting and could lead to financial instability for the insurer if claims arise that were not adequately priced for. It is also an ethical failure, as it prioritizes administrative ease over the integrity of the insurance contract and the financial security of all parties involved. Professional reasoning. Professionals should approach such situations by adopting a systematic risk management framework. This involves 1. Acknowledging and documenting all audit findings. 2. Initiating a fact-finding process to understand the nature and impact of the discrepancies. 3. Communicating proactively and transparently with the insured to gather information and explain the insurer's concerns. 4. Evaluating the impact of the findings on the existing risk assessment and policy terms. 5. Determining appropriate actions, which may include further investigation, policy adjustments, or discussions about operational improvements. 6. Ensuring all actions are compliant with regulatory requirements and ethical standards. Question 20. Consider a scenario where a commercial underwriter is assessing the potential loss given default (LGD) for a significant loan facility to a manufacturing company. The company has substantial tangible assets pledged as collateral, including specialized machinery and real estate. The underwriter must determine the most appropriate method for estimating LGD, balancing the need for accurate risk pricing with regulatory compliance and the insurer's capital adequacy. Which of the following approaches best reflects sound underwriting practice and regulatory expectations for LGD estimation in this context? Option A. Applying a standardized LGD percentage derived from broad industry historical default data for similar loan types, without specific adjustments for the unique characteristics of the collateral or the current economic environment. Option B. Relying on a blended approach that incorporates a detailed, up-to-date valuation of the specific collateral, an assessment of the seniority of the insurer's claim, and an estimation of the costs and timeframes associated with asset liquidation and legal recovery processes, adjusted for current market conditions and the borrower's industry outlook. Option C. Using an LGD estimate that is primarily driven by the borrower's historical repayment performance, with minimal consideration for the value or recoverability of the pledged collateral in the event of default. Option D. Prioritizing a rapid LGD estimation based on the book value of the collateral, assuming a quick and efficient sale process with minimal recovery costs to expedite the underwriting decision and maintain competitive turnaround times. Correct answer is B. Relying on a blended approach that incorporates a detailed, up-to-date valuation of the specific collateral, an assessment of the seniority of the insurer's claim, and an estimation of the costs and timeframes associated with asset liquidation and legal recovery processes, adjusted for current market conditions and the borrower's industry outlook. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need for accurate risk assessment with the potential for adverse selection and market disruption. The concept of loss given default (LGD) is critical in commercial underwriting, as it directly impacts pricing, capital allocation, and the overall profitability of a loan portfolio. Misjudging LGD can lead to underpricing risk, insufficient capital reserves, and ultimately, significant financial losses for the insurer. The OM designation implies a need for sophisticated understanding beyond basic calculations, focusing on strategic implications and regulatory compliance. The correct approach involves a thorough, data-driven assessment of LGD that considers all relevant factors influencing recovery rates post-default. This includes a detailed analysis of collateral quality and valuation, the seniority of the debt, the borrower's industry and economic outlook, and the legal and administrative costs associated with recovery. This approach aligns with the principles of prudent underwriting and regulatory expectations, which mandate that insurers maintain adequate reserves to cover potential losses. Specifically, regulatory frameworks for commercial insurance often require insurers to demonstrate robust methodologies for estimating reserves, including those related to credit risk and potential defaults. Adhering to these principles ensures financial stability and protects policyholders. An incorrect approach that relies solely on historical averages without considering current market conditions or specific borrower characteristics fails to adequately capture the nuances of LGD. This can lead to an underestimation of potential losses, violating the regulatory requirement for accurate reserve setting, and potentially exposing the insurer to solvency issues. Another incorrect approach that overemphasizes recovery potential based on optimistic assumptions about asset liquidation or market recovery, without robust supporting evidence, also represents a failure in due diligence. This can result in inadequate provisioning and a misrepresentation of the insurer's financial health, which is a direct contravention of regulatory principles of transparency and sound financial management. Furthermore, an approach that prioritizes speed of underwriting over the accuracy of LGD estimation, perhaps due to competitive pressures, risks significant financial exposure and a breach of the underwriter's fiduciary duty to the insurer and its stakeholders. Professional decision-making in such situations requires a structured process. First, clearly define the scope of the LGD assessment, identifying all relevant influencing factors. Second, gather and critically evaluate all available data, including collateral appraisals, legal documentation, and market intelligence. Third, apply a consistent and well-documented methodology for estimating LGD, ensuring it is aligned with regulatory guidance and industry best practices. Fourth, stress test the LGD estimates against various adverse scenarios to understand potential downside risks. Finally, document the entire process and the rationale behind the LGD determination, facilitating review and ensuring accountability.